Have you ever wondered why high yield dividend stocks are so appealing to investors? Let's take a moment to demystify this concept. High yield dividend stocks are essentially shares in companies that regularly pay out a portion of their profits to shareholders. These payments, known as dividends, are typically distributed on a quarterly basis. What makes these stocks high yield is the fact that the dividend payment is substantially higher than what is offered by other stocks. But why are these stocks so enticing? First off, they provide a steady stream of income. This is particularly attractive to those seeking a consistent return on their investment, such as retirees who rely on this income for their living expenses. Next, there's the potential for capital appreciation. This is the possibility that the value of the stock itself may increase over time. So, in addition to the regular dividend payments, investors could also profit from selling the stock at a higher price than they initially paid. Furthermore, high yield dividend stocks can act as a hedge against market volatility. During economic downturns, these stocks tend to hold their value better than others, as the dividend payments can provide a buffer against falling stock prices. However, like any investment, high yield dividend stocks come with their own set of risks. The high dividend yield could be a sign that the company is in distress and trying to attract investors, or it could mean the company is not reinvesting enough of its profits back into its business, which could limit its future growth. So it's all about balancing the potential rewards with the inherent risks, and that balance can only be achieved through careful research, due diligence, and often some professional advice. So high yield dividend stocks can offer a great way to diversify your portfolio, but how do they stack up against other types of investments? That's a question we'll be delving into in the next segment. Stay tuned. Now, let's put high yield dividend stocks in the ring with other types of investments. Let's begin with bonds. Bonds are typically considered less risky than stocks. They provide a steady stream of income through interest payments, and you're guaranteed to get your initial investment back as long as the issuer doesn't default. However, the potential returns from bonds are generally lower than those from high yield dividend stocks. And in an environment where interest rates are low, bonds may not provide an adequate return after accounting for inflation. Next up are mutual funds. These are collections of stocks, bonds, and other assets managed by a professional. They offer diversification, which can reduce risk. However, they also come with management fees that can eat into your returns. High yield dividend stocks, on the other hand, don't come with these ongoing costs. Plus, they offer the potential for both income from dividends and capital appreciation. Lastly, let's consider growth stocks. These are stocks of companies expected to grow at an above average rate compared to other companies in the market. While they can offer substantial returns, they are also associated with a higher level of risk. They often don't pay dividends as they reinvest their earnings to fuel further growth. High yield dividend stocks, on the other hand, provide income regardless of market conditions, which can be particularly valuable during market downturns. However, it's important to remember that all investments come with some level of risk. High yield dividend stocks, while attractive for their income potential and the opportunity for capital appreciation, are not immune to market fluctuations and company-specific risks. That's why having a diversified investment portfolio is crucial. It allows you to spread the risk across different types of investments, potentially leading to more stable returns over time. As we can see, while high-yield dividend stocks have their unique advantages, there's no one-size-fits-all in investing. Before we wrap up, let's summarize the key points we've discussed. High-yield dividend stocks have a certain allure that's hard to ignore. They offer steady income, the potential for capital appreciation, and serve as a buffer against market volatility. They're a bit like the tortoise in the fable, slow and steady, but ultimately reliable. Think of it like this: if the stock market is a wild, unpredictable ocean, high-yield dividend stocks are the sturdy ships that weather the storm and keep you afloat. They don't just offer a one-off payment. Instead, they provide a consistent income stream that can be a lifeline in uncertain times. Plus, there's always the potential for capital appreciation. That's the beauty of it. You're not just relying on the dividend payments. The share price can also go up, giving you a nice little bonus. But let's not get carried away. As we've seen, when compared to other types of investments, high-yield dividend stocks aren't always the top performers. Sure, they can provide a decent return, but they're unlikely to make you a millionaire overnight. It's important to keep your expectations realistic. That brings us to another crucial point: diversification. If there's one golden rule in investing, it's this: don't put all your eggs in one basket. High-yield dividend stocks can be a valuable part of your investment strategy, but they shouldn't be the only part. It's essential to spread your investments across a range of asset classes to reduce risk and increase potential returns. Think of it as a safety net. If one investment falls, others can help cushion the blow. Remember, investing is a journey, not a destination. High-yield dividend stocks can be a valuable part of that journey, but they should be just one part of a well-diversified portfolio